Welcome back to the Bitcoin Treasuries podcast. This is the closing bell. I'm Tim Kotzman. I'm here with Parker. Parker, thanks for joining us today.
Thanks for having me, Tim.
For those not familiar with you, this is the first time there's multiple Bitcoin Treasury podcasts, right? Tyler does a great job over at bitcointreasuries.net. This is the Bitcoin Treasuries podcast with Tim Kotzman. Can you give us a little bit about your background and we'll kind of make our way to digital credit here in a little bit?
Sure. So my background come from the kind of the finance side of things rather than the tech side. So spent the early days of my career on the buy side. I managed about a $2 billion fixed income, primarily portfolio for a number of institutional clients. Obviously, not just me. There's a whole team. I was a lowly analyst and kind of junior PM. But so during that time, got my CFA and kind of got into markets. And then from there, got into crypto in 2017. Really started going down the Bitcoin rabbit hole in kind of mid 2018. And, interestingly enough, kind of growing up, I think my dad really primed me to be a bit of an Austrian. And so I remember reading Hayek's Road to Serfdom when I was 12. And, I was homeschooled growing up. So kind of an alternative, upbringing or background, if you will. And so once I really started going down the Bitcoin rabbit hole, a lot of things started to click for me. And so joined Kraken at the end of 2018, was at Kraken for until early 2025. So that was, about 6 years. And then me and some former Krakenites, we got together and launched DFDV, which was the first non-Bitcoin treasury vehicle. So this was in April of 2025. And then, we saw what Saylor was doing with STRC. And, obviously very interesting. And it was the largest IPO of 2025 of any kind. 2025 was a bit of a lighter year for IPOs, but nonetheless, a preferred stock being the largest IPO was, pretty interesting. And so we got together and launched Apex in January or so of this year. And, I've been building and growing ever since. So that's the background.
I guess, what were you doing over at Kraken out of curiosity? And then can you kind of give an overview of DFDV and what you guys set out to do in the beginning?
Sure. So at Kraken, I held a number of roles. So spent some time on kind of this strategy team, and we did a lot of, anyone who's worked in management consulting knows, the board decks and the memos on different stuff. And then we also had a kind of a sell side research type desk. So I helped publish some content there. And then moved over to the engineering side. So I spent 3.5, 4 years on the engineering side, a mix of data engineering and then AI and ML. And when I left, I was the director of engineering for all AI and ML initiatives. So a little bit about my time at Kraken, kind of held a bunch of different roles, bounced around different areas. The general idea with DFDV was, and still is, we saw what MicroStrategy had done with Bitcoin, and we thought there was room to do so with other, kind of major crypto assets. So we launched ours on Solana. I'd been running some Solana validators on the side with some buddies, prior. And there's some interesting components to the kind of, the Solana ecosystem and the Solana, the asset, particularly the staking yield, that makes it potentially a better fit or somewhat of a better fit for a DApp vehicle, where rather than having this like, hey, where does the yield come from to like pay the prefs or like do the things? And, Saylor has to explain basically selling off capital gains, and that like just breaks people's brains. With something like Solana, you just have the staking yield. And so you're just like, oh, the staking yield funds of things, like end of story. And for some reason, like most people understand that a little easier. And so, we acquired a tiny Nasdaq listed company. Um, in about 7 weeks, the stock was up 9,700%. And so I think for the full year 2025, even despite the big DAT drawdown, the stock was still like, I think, the fifth best performing stock on the entire NASDAQ in 2025, which was pretty cool. But so we rolled in my validator business, and then did a convertible bond offering, the only non-Bitcoin company to ever, or a treasury company to ever do a convertible offering. And I've been kind of working on doing a pref similar to Stretch or SETA as well. Tough market to do so, but that's kind of the backstory on DFDV.
What you're thinking, since you just mentioned, contemplating doing your own pref, like where's the ceiling maybe on too high of an interest rate, according to a lot of, whether they're retail or especially institutional investors? Because you have 12, 13%. I've heard, I guess I'll say rumors, but just through conversations of people, like a lot of investors do not want to see 14%. Like I don't know why that exactly is. Do you have any thoughts there as to like, I don't know. I was talking to some investment bankers who, months and months ago were like, oh yeah, you can launch a pref at 7 or 8%. I'm like, that doesn't mathematically make sense if the market already has 12, 13% there, but maybe they don't want to see something that, if it's a higher percentage rate, they might view it as more risky. Or how do you think through those sorts of things?
Yeah, it's a great point. I think the market could tolerate a little bit more yield and risk than, say, a SETA, but substantially more. I think there's a good point. I don't think anybody's really tested the frontier of the risk curve. Like, where does the ocean fall off? Like, where is that cliff? Is it like at 14, or is it 15 or 16? Like, it's tough to say. But I think in a bull market, obviously, a lot more things work. And so, you might not really figure out, how much is too much until a bear market, which we're in. So you kind of like have to wait till the bull market, launch in the bull market, and then like figure it out in the next bear market, which is, probably a long ways away. So, but I do think it's a valid point, in relation to, say, a Stretch or a SETA, like continuing to ratchet up the yield. Does that like fix the price issues? Probably not. Somewhere around where they're at now, I think makes probably the most sense.
And then how do you think through DeFi and Solana yield, or like the DeFi investor ecosystem versus retail Bitcoin investors, or like non-Bitcoin retail and institutional investors that are like just looking at the number through a very traditional finance, Wall Street sort of lens?
Yeah, so I think ultimately what we have here is a pretty general purpose engine. That's the way I think of digital credit. Well, Bitcoin's the engine. But or maybe you say Bitcoin is the gasoline, and Saylor has figured out how to create this like, big block V8 engine that can work in a lot of different places. It can work in, an F-150. It can work in a Raptor. It can work in a boat. It can work in a plane. Like, this same engine, some small modifications to it, works all over the place. And so I think what Strategy has done is basically proven out the engine in public markets, and they've created the engine, but you can put the engine in all sorts of vehicles. And so Stretch itself is a pretty interesting vehicle, and it directly taps into US and some non-US, but mostly US, retail and increasingly institutional credit investors. But there's 300 million people in the US, probably 50 million or something that are like part of the investing public. There's 7 billion people on the planet. And so I think one of the powerful things that crypto does and these DeFi platforms is it brings modern financial services, and in some cases even like better than modern financial services, to the rest of the world. So an interesting example is, most brokerage platforms won't offer margin or leverage on Stretch. Maybe for some reasonable reasons, but some people want to lever it nonetheless. You can lever it in DeFi, and there's all sorts of ways you can get that leverage. You can do straight looping. You can, just borrow against it to buy other things. There's these tranching protocols that you can, buy the junior tranche, and that's another form of leverage. You can now buy perps on Hyperliquid to get like insane leverage, 75, 100x leverage on basically Stretch. And so I think about DeFi as really this like financial services platform. Schwab meets the NASDAQ, meets, some prime broker, and you can plug in all these different assets. And so what we've effectively done with, at Apex is taken this engine that Strategy has built, this Bitcoin backed credit, and we have packaged it or wrapped it for on-chain DeFi usage. And it, needs to look a little bit different. It's not exactly the same. We're going to a boat race here versus sailors in the NASCAR race. So our engine and our car needs to look a little different, but the fundamental building blocks are all there. And, there's, again, 6.5 billion people on the planet that don't really have access to Stretch, and they can get access through DeFi. And that's, just a very cool thing.
Absolutely. There's been talk about Strive and Strategy, and we actually talked about this on the roundtable with Tyler earlier about other ones coming to market. Do you think it's just too early to tell, or is there like the reality is once you get into the next bull market, it's like wide open, because you can, just like there's hundreds of ETFs launched every year. I mean, there's so many different flavors of how you can engineer this and market it that it really is like, if Stretch is the iPhone, it's just like, all right, well, you can, there is a big market, or it's like, nope, there's only going to be 2 or 3 or 4 of these things in the U.S. market. I don't want to lead the witness, but it seems like the market could be wide open as the market sentiment and price action comes back. Do you share that, or is it more nuanced than that, or it's like, oh yeah, no, we're just at the starting line?
Yeah, I think we're certainly at the starting line. I think the bull market comes back and there's going to be more of these. And then obviously Stretch and SATA are going to do fantastically well too. I do think each of the issuers is going to need to have their own take. They can't just be a complete clone of Strategy or Strive. And so probably some type of, operating business or yield component could be an interesting one. Obviously, different geos and different currency denominations are interesting. But I do think like you got to have some differentiation. Like I don't see what a strict Stretch or SATA clone would really bring to the market, and why people would pile in if the same underlying asset is just Bitcoin held on a balance sheet. But, small variations, tweaks to that. Going back to the iPhone example, though, there's a couple different models of the iPhone, and then there's a whole bunch of Android phones out there. So there's obviously room, but yeah, you can't have just like an exact clone.
Can you take us through Apex, the journey, the flows, what surprised you, what has not surprised you?
Sure. So the way that Apex works, our kind of flagship product is APX USD. And APX USD is a non-yield bearing dividend backed dollar. We kind of call it a stable coin, but it's not, stable all the time, although we're working on that. Um, and then you stake it and you get APY USD. And APY USD pays about a 13% yield. And this is a very standard kind of crypto structure. Anybody that has dealt with yield-bearing stablecoins at all, understands this kind of two-token model. So we really tried to kind of clone what has already worked in crypto and DeFi from a yield-bearing perspective, but we swapped out the engine. So the yield engine. So rather than using, say, a basis trade or private credit or, reinsurance or one of these other yield engines that, some of these other yield-bearing stablecoins use, we just used Stretch and these variable rate non-convertible preferreds. And so by bringing this new engine in a very familiar packaging that crypto people didn't really have to take a lot of time to ramp on. It was just like, oh, I see what they're doing here. This makes exact sense. It's like this, but, slightly different. And so that allowed us to grow really quickly. So I think it was within 8 or 9 weeks of launching, we, crossed 250 million in assets. Maybe 3 months in, I'm kind of maybe butchering the numbers a little bit, but 3 months in, we were, north of 400 million in assets. We've certainly come down some since then, kind of basically tracking the performance of Stretch. But I think the fact remains that people want high, double-digit yields on chain with a transparent backing. So the problem with a lot of these yield-bearing assets in DeFi today is the backing is not very transparent and illiquid. And so they kind of bump along at $1 and it's all great. And then one night you wake up and it's not $1. And it didn't go down to 95 cents or 90 cents. It went down to 5 cents and it's just poof, gone. And so, we said, hey, let's, with Stretch, you can see the assets. We do monthly attestations. We have an auditor, actually the auditor from DFDV comes into Apex. They take a look at the books. They say, look, here's all the Stretch they have. Hold some of it in Stretch X, tokenized Stretch on chain. Some of it's in a brokerage account. The assets are there. You may not like that they went down and it's a bummer. The asset traded down to, 80, 75 cents on the dollar, but it's trading back at 95 cents on the dollar right now. And you kind of understood the whole time what was going on. So a bit of a bend, not break type setup here. But ultimately, there is this desire for double-digit yield in DeFi. And that's not going to go away. And so I think Stretch is an incredible instrument for providing that, especially because the ultimate backing, Bitcoin, is something that everyone understands. I mean, there's very few maxis in my view, like ETH maxis that are, deep into DeFi. Most DeFi users, they've got some Bitcoin, tokenized Bitcoin, they trade perps, they might have a little bit of RWA exposure, maybe they punted Micron or aped the SpaceX IPO or something. People just want to create a better life for themselves. And if, double-digit yield helps them get there, they're all game and it's backed by something they trust, Bitcoin. So that's kind of what we set out to do here at Apex. And, over time, I think we'll probably launch some other assets backed by maybe some other things. But, I think digital credit is always going to be our kind of North Star and flagship here. And I think it's a giant, giant market. And I think there's tens of billions of capital in DeFi that are interested in this type of thing.
If Stretch is paying 12% and you guys are paying 13%, how does that work? What am I missing there?
Yeah, so this is where the two-token model comes into play. So we've got the portfolio right now is about 85% Stretch and about 15% cash. So that actually comes out to a 10 or 11% blended yield. But some people hold APX USD, which is the non-yield bearing version. So same collateral basket, no yield, all of that yield flows over to the APY holders, or most of it. And the APY holders have like a bit of a lockup. So it's a 20-day unstaking period. You can unstake quicker than that, and you can also trade out in the market. But if you unstake quicker, there's a bit of a fee. And so we added that little bit of duration. And so some people prefer to hold the non-yield bearing version. And because we're not paying them yield, we're able to pay the yield bearing version more yield. And this is, again, going back to that like standard crypto wrapper. Like there's a dozen yield bearing coins that do this exact same thing on chain. And so people are very familiar with this model, and it's just kind of the way things are done.
Got it. Okay. Super helpful. I guess based on your background, how many different chains do you think you'll see digital credit rolling out on that are kind of not just commercially viable, but like the kings of the market in crypto, the cryptoverse, which I am not as familiar with because I'm just focusing on the Bitcoin treasury companies. And will that give those rails more value, or like is that another use case for it, or are they just kind of like rails at this point? I'm super kind of purely ignorant and unfamiliar, so kind of curious your take on that.
Yeah, look, I think Solana and Ethereum are going to be the two dominant chains. I just, sorry, Sui Bros or Aptos Bros or whatever else, L2 Robinhood Chain Bros, but like I just don't think anything other than Ethereum mainnet and Solana are going to attract much activity and users long term. And you've kind of seen that play out historically, where the majority of users and revenue happens on Solana. The majority of TVL, the whales all hang out on Ethereum mainnet. Base kind of had a bit of a run, Binance Chain, but like none of these things really have staying power because they just don't offer something that much better than, one of these two existing platforms. The big push in crypto right now has been around RWAs, so real world assets, a lot of tokenized stocks, tokenized treasuries and T-bills, Hyperliquid's very interesting, perpetual swaps platform that I think 8 of the top 10 contracts traded on Hyperliquid are non-crypto. It's like BTC and ETH, and sometimes Sol sneaks in to like the 10th spot, and then the rest are, in fact, maybe I'll look it up right now.
I guess this begs maybe an additional question, which is I was listening to Scott Melker on Mr. Schiff's podcast, and he was like, through the years, a lot of these crypto tokens have not been structured in a way that the value is accrued to the token, but when these new crypto projects come out, then it'll be better. Do you share that take? I don't even really know what that means. So again, just really curious and trying to learn here.
Yeah. So kind of wrapping up on the Hyperliquid side. So I pulled up the top 10 contracts on Hyperliquid in terms of volume traded. Number 3 is the NASDAQ. Number 4 is Micron. Number 5 is the S&P. 6 is oil. 8 is silver. 9 is Brent. And 11 is gold. So people are trading non-crypto assets on crypto rails in significant size. And, what's interesting is like the market's closed. This is the closing bell and, show. And people are trading these assets. And especially over the weekend, you've seen a number of these moves in the energy markets where, Trump and the Iranians try to do like some dealing, some discussions over the weekend. And because markets are closed, but not crypto markets. And so the only place that people can trade oil contracts, oil futures, is in crypto markets. And so I think you're going to see more and more of that. trading earnings, that happen after the bell. Lots of reasons that you might want to trade just traditional assets on chain for Americans, not just for people that say don't have access to U.S. Traditional assets. To your question about the tokens, it's a multi-part problem. Obviously, the regulatory environment created a pretty big headwind where none of these tokens could ever be structured like equity, because if they looked too much like equity, then they would be equity, and then they'd be a security on chain, and then they'd be in prison. And so they had to structurally set these up such that they didn't really have any of the rights or protections that standard equity holders would have. So I think that's improving and it's getting better. And some founders will make their tokens, and you're starting to see this more and more. But some projects and founders will make their tokens really behave a lot more like equity. And, that'll be great for the industry and for holders of those assets. But the other piece to it is, there are a lot of shysters in crypto, and, the Bitcoin maxi kind of, view on the crypto sphere is not entirely incorrect. Like, there are scammers, there are shysters, there's real builders too. But some of these folks have used this kind of inability to structurally design tokens to effectively be equity to their advantage, to basically ship tokens, put them out there, monetize them, and then just let them die. And you've seen some projects that they also have a labs co, and it has venture investors in it, and they're talking about IPOing their labs company, and it's wait, you guys also have the token, what's going on here? And so I think they've kind of hidden behind this, well, the regulatory environment won't let me do it, so this is why I set it up this way. So my hope is that, the regulatory environment clears up, and that honest founders can create tokens that behave much more like equity. And then everyone else who's trying to be a scammer really has no more excuse to do so. And you start to see a bit of a resurgence in demand for these tokens. Because, there's some really interesting projects that have tokens, whether that's Hyperliquid or, Uniswap, Aave, Morpho, Jupiter, some of these very foundational pieces of technology that, manage tens to hundreds of billions in assets that are kind of applications built on top of a layer one. And if those were businesses in the real world, their equity would have meaningful value. But because their tokens have been kind of caught up in this quagmire, people just don't place the value on them that they would if they were straight equity. So hopefully we'll see a bit of a pendulum swing towards, kind of the right direction, if you will, especially as maybe some regulatory clarity comes.
I'll leave it to you if you have any final thoughts on where can people reach out to you, reach out to Apex, and connect and learn more.
Sure. So our website is apyx.fi. Pretty simple. You can follow us on Twitter as well, apyxfi. You can follow me as well at the other Parker _. But yeah, come check us out. It's pretty interesting. We've had some folks pop into Discord and say, hey, I've been a Bitcoiner, for quite a while. I've never played around with some of this DeFi stuff, but here I am. I'm kind of, getting my feet wet, ready to learn. So for Bitcoiners that maybe have not played around with DeFi at all, it's kind of an interesting way to get involved. You can start with, small balances, $50, $100, whatever, and kind of see what financial services, backed by Bitcoin, but built on, crypto rails instead of TradFi rails can look like. So it's been cool to see more Bitcoiners, historically, maybe even maxis, starting to get involved a little bit and test this stuff out because, finance is better, the world is better when everyone's involved, not just one kind of corner of the market. So that's what I'll wrap up with.
Awesome. Well, Parker, appreciate the time, and I'm sure we'll be chatting soon.
Cool. Thank you for having me on.